The Opendoor Technologies Inc. (OPEN) stock is currently trading at $8.08, showing a modest intraday gain of plus 1.64% as of the latest market activity on October 29, 2025. This small upward movement, however, masks a fascinating internal dynamic, a quiet but aggressive accumulation phase among sophisticated institutional players that is flying directly in the face of the general market's gloomy consensus on the iBuying model. Most retail online investment circles are focused on the long-term pain Opendoor has endured, the deep drawdowns from its highs, and the ongoing interest rate pressure on the housing market. They see a fragile balance sheet and a business model perpetually tested by macro forces. But what the trading volume is really telling us is that big Fidelity investments and other large funds have been steadily increasing their positions, betting not just on a survival story, but on Opendoor emerging from this housing cycle with a streamlined, cost-efficient operational structure that fundamentally changes the risk profile of the business. This institutional belief is the true engine behind the stock's resilience, especially considering the 52-week high is near $10.87 and the low was only 51 cents, a massive swing that creates a technical setup ripe for a major move if the narrative flips. Recent stock movement, institutional whispers, and volatility. The common perception of Opendoor Technologies Inc. is that it's a volatile, speculative bet directly tied to the whims of the housing market and interest rates. For the past several months, the prevailing wisdom has been to avoid real estate tech stocks, given the restrictive environment for buyers due to high mortgage rates. This expectation, however, is being directly challenged by the stock's recent price action. While the daily swings might appear random, a closer look at the volume spikes, especially those coinciding with price resistance levels, indicates a determined buying presence. This isn't the typical pump-and-dump action of a retail-driven meme stock. This is the measured, large block purchasing characteristic of institutions building a meaningful stake. When you see a 52-week range so vast, from that low of 51 cents to a high over $10, you know the market is deeply divided. The current trading near $8.08 suggests the optimists are winning the immediate battle, pushing the price closer to the top of that consolidation range that has formed over the last quarter. Trading volumes have been elevated, often significantly above the 30-day average, suggesting a high degree of contention between sellers, likely retail and short-term traders taking profits, and the institutional buyers who are happy to absorb those shares. The sheer number of shares currently held short, over 161 million, representing more than 22% of the float, creates a massive coiled spring effect. Any sustained positive news, particularly a better-than-expected earnings report coming up on November 6th, could trigger a sharp squeeze, forcing those short sellers to cover their positions rapidly. This short interest overhang is a tension point that many sophisticated self-investing individuals tracked closely, as it represents a huge forced buying pressure waiting to be unleashed. The core of the matter is that the market is waiting for a concrete signal, either a disastrous earnings report that validates the short thesis or a profitability inflection point that forces a massive repricing of the stock. Until then, the stock will continue to show technical strength against macroeconomic headwinds driven by the belief that the worst of the cycle is behind them and the operational leverage is about to kick in. This is a very different angle than simply looking at the latest pending home sales figures. The Opendoor business model, a hard-nosed operational shift. To understand the stock's current technical strength, we have to grasp what Opendoor actually does, and more importantly, how their model has been stress-tested. Opendoor at its core is an iBuyer, a company that uses proprietary algorithms to make instant cash offers on homes, purchases them, performs necessary light renovations, and then quickly relists and sells them. They are in the business of liquidity and speed in real estate. The simple expectation is that if home prices are falling, Opendoor loses money because they buy high and sell low. The reality, however, is that management has been hyper-focused on risk management and operational efficiency since the last housing slowdown. Their business model is no longer just about buying and selling homes. It's about collecting an efficient transaction fee on every home, regardless of macro price changes. They make their money through a service charge, and the key is minimizing the amount of time they hold an asset, the inventory holding period, and reducing the loss they take on any single transaction. Older reports will show massive losses, particularly when the housing market turned sharply in 2022. That's the reality the market got burned by. However, the expectation has since shifted. The market expects continued losses. The crucial point of divergence, the fresh angle that sophisticated investors are keying into, is the massive reduction in the gross margin loss per home and the overall streamlining of their pricing algorithms. They have gotten better at estimating repair costs and, crucially, at moving inventory. If they can continue to shrink their losses towards zero or even achieve consistent, modest profitability on a per-transaction basis, that changes everything. They are creating a scalable platform where the primary variable, the unpredictable price of a home, is increasingly mitigated by the quality of their data science and the speed of their operations. The recent online investing trend towards platform-based business models is relevant here, as Opendoor is essentially trying to turn an analog, clunky real estate process into a clean, digital transaction on a platform that they fully control. They also offer ancillary services, such as title and escrow, which add higher margin revenue streams, a common strategy you see with companies like SoFi Invest, which bundles financial services. Institutional activity and sector context. The institutional money flow into Opendoor Technologies Inc. is perhaps the most compelling story right now. You're not seeing the typical high-growth, high-multiple buyers like a couple of years ago. The buyers now are often value-oriented funds who see a company with a market capitalization around $6 billion that has already absorbed the worst of the cyclical pain, still possesses a valuable proprietary data asset, and is positioned to benefit dramatically from even a slight softening in mortgage rates. The recent news of a few analysts raising their price targets despite the general housing gloom is a direct reflection of this institutional optimism. They aren't raising targets to $50, they're raising them to a more grounded number that still represents a massive upside from the stock's 52-week low. This incremental shift in analyst sentiment, often driven by quiet conversations with management about operational improvements, is a key indicator for people who follow individual brokerage and fund activity. Looking at the broader sector, Opendoor exists in the real estate tech space, often compared to Zillow. However, Zillow moved away from iBuying, which underscores the high-risk nature of the model. Opendoor is the last big pure-play iBuyer, which makes it a unique leveraged bet on the eventual stabilization and recovery of the housing market. They have peers, of course, but Opendoor's scale gives them an advantage in data collection. They have seen more transactions and have more information to feed their algorithms. This data moat is a valuable, often underestimated asset. When we talk about major brokerages like Fidelity or Interactive Brokers, their research arms are acutely aware of the leverage Opendoor offers. High exposure to housing volume, but with an operating model designed to neutralize price risk over time. If they succeed, the stock price becomes disconnected from home price appreciation and more connected to transaction volume. This is the expectation versus reality tension. The expectation is a failing real estate company. The reality is a technology company whose financial success is about to pivot away from home price appreciation and toward transaction efficiency. Future outlook, scenarios, catalysts, and risks. The future of Opendoor Technologies Inc. hinges on a few clear catalysts and corresponding risks. Scenario 1. The soft landing pivot. Reality exceeds expectation. This is the bull case the institutional buyers are positioning for. the Federal Reserve hints at or actually starts easing interest rates slightly in the next 12 to 18 months. Even a small drop in mortgage rates, say from 8% down to 6.5%, could trigger a massive surge in transaction volume. Because Opendoor has focused on operational efficiency during the downturn, they are structurally positioned to handle a massive increase in volume at a lower cost per transaction than ever before. If they can achieve even slightly positive unit economics on high volume, the revenue growth will be explosive, and the stock will reprice dramatically higher, potentially challenging its all-time highs as the market moves to assign a growth multiple to the name. The coming earnings report on November 6th is the immediate acid test for this scenario. If they can show a significant beat on transaction margins and a much narrower loss than anticipated, that sets the stage. Comment below how many shares of Opendoor Technologies you currently hold, or if you think the iBuying model is fundamentally broken. Scenario 2. The prolonged stagnation. Expectation meets reality. The bear case is that high rates persist for another 18 to 24 months, keeping transaction volumes depressed. In this environment, Opendoor's operational improvements are not enough to overcome the lack of scale.